Hi, welcome everyone to your lecture on financial regulation. I'd like to start out by introducing myself. So my name is Rose Cox and I'm an attorney in the state of Maine. And I actually work at TD Bank as a corporate compliance manager. I always knew that I wanted a non-traditional career path that kind of intersected business and law. So I'm very fortunate to have landed in compliance, and I hope you guys will learn a lot about compliance and the impact of financial regulation on your day-to-day life. So the way that I've structured this course is I've broken it out into 4 distinct learning plans and kind of given you independent reading and a video lecture to accompany it. So hopefully between the two you'll be able to pick up on the key points. This is the first of 4, although I think what we're going to do is actually have you pause whenever you get the end of the first lecture, and then you can do the assigned reading for the next lecture and so on and so forth. So the 4 topics that we're going to talk about today, the first one is Introduction to Financial Regulation. The second one is Rulemaking Activity. The third will focus on trends in financial regulation. And then the last, of course, being how does financial regulation impact me? So I think that one will hopefully be the most interesting for all of you guys. So if we jump right in, starting with the first item for today, we're going to first talk briefly about the fact that you have 3 assigned readings, and I tried to make these as modern and current as I possibly could so they're not boring and unintellectually stimulating. So I hope that you can kind of read them and enjoy them and then kind of reinforce the same general thoughts through watching the lectures. So if we start with the idea of what is banking compliance, a lot of people ask me what's the difference between being a compliance professional and an attorney. Well, first I would say that compliance is a major part of almost every financial institution and starting to be more so part of many different types of institutions, becoming kind of a mainstay in just the corporate world in general. And what compliance is it focuses on supporting the business as they identify new regulatory changes that require some sort of change to the business operations, and then also not going away and making sure that they continue to partner with the business past the implementation period of new regulations to kind of verify that the business maintains compliance with the requirements of the law, and that if there were any issues, that compliance helps monitor and identify those issues. So the good news is that compliance professionals are not just lawyers. There's a big group of compliance professionals that are actually from many, many different backgrounds, and it's nice actually to work with these people because there's a lot of different diverse perspectives. There's a lot of people that came up through the business line and they know a lot more about the business's day-to-day operations, so they're very valuable in that sense. So a lot of different people, any of you could go into a compliance field without necessarily having to go to law school. So that's definitely a big advantage for anyone who's interested. Also, as far as how compliance differs from legal, so legal is kind of limited to only providing interpretive advice. So what that means is any of those gray areas where compliance says, well, the law doesn't really answer my question, and I'm not really sure how to answer the question without really digging into the regulations. So those are the type of areas that we kind of hand off to legal and ask for them to provide interpretive advice. So that differs from the role of compliance, despite the fact that compliance is spending most of its days reading regulations and helping the business understand the requirements of those regulations. So if we talk about banking regulation, banking is a highly regulated area of law, as you can imagine, because banks do hold assets on behalf of their clients. So from that standpoint, it's important that we trust our banks, and it's important that banks are ethical with other people's money and don't create major concerns like the 2008 financial crisis. So, even internal aspects of a bank are now monitored in the current state, not just the mortgages or the deposits that they take, but also what they do with their own profits. Because after the 2008 financial crisis, there was a lot of talk that we just could not let that happen again, and so banks now are in a position where there's a lot of different regulators, mandating what they can and cannot do. And, this has increasingly been the case since 2008, although I will say recently, so very recently after President Trump took office, there's kind of been the reverse trend where President Trump has outright said that he does not necessarily support such a rigorous financial regulation on banks. And so there's kind of been a standstill. And as individuals are replaced under President Trump in these agencies, there's kind of been a shift that regulatory burden is starting to be relieved a little bit off of banks. And definitely there has not been as much rulemaking as there was prior to him taking on his new administration. So I think it all kind of hinges on the Dodd-Frank Act. It's hard to talk about banking regulation without talking about the Dodd-Frank Act. So the Dodd-Frank Act was enacted in response to the 2008 financial crisis with the main goal of preventing a similar crisis from ever occurring again. And many of you may know that there were some banks that were bailed out by the government because of their poor decisions leading up to the financial crisis. So Dodd-Frank made numerous changes, and actually Dodd-Frank is not fully enacted, believe it or not, despite being almost 10 years since the act was passed. There are still many provisions that the regulators have not had time to get to or are in disagreement on, so they just have not yet issued new rulemaking. But in general, I think there are three main things that people should know about the Dodd-Frank Act. The first is that banks are required to hold more capital. And that's just really speaking to the type of assets. Banks need to make sure that they're holding valuable assets and that they're not just padding their books and making themselves look like they have a lot of money, but that they actually do have valuable money and assets. And also that banks need to hold more liquidity. So if there is a run on the bank, banks can't turn all of their liquid cash into other assets and then say, well, hold on, I need a little more time to convert it back to cash, because that's not going to work. It creates market panic, and so there are some requirements on what the bank can do as far as the amount of liquidity they can hold. Also, large banks are subject to stress testing. So that basically means that they are given scenarios that are hypothetical that could happen in the economy. And based on those scenarios, they're then required to prove that they have enough capital and liquidity to withstand financial hardship. So those are some exercises that are mandated on banks now in the current state. Also, one of the biggest things I would argue was the creation of the Consumer Financial Protection Bureau. So the Consumer Financial Protection Bureau is probably the first regulatory body, I would say, definitely in the banking industry, that is charged with consumer protection above all else. So instead of looking at, is the bank making good decisions for itself, the Consumer Financial Protection Bureau is saying, are you making good choices on behalf of the customer? Are you treating them fairly, or are you being abusive, and things along that line? So that is the main task of the Consumer Financial Protection Bureau. So if we move on to regulator authority overview, so there are really four main players in financial regulation, I would say, for most national banks. And I will give the caveat that I'm going to focus on this for the national bank perspective, because that's where I work for, as a national bank. So any of your larger banks are subject to this type of regulation. Any of the smaller banks, like the credit unions and smaller entities that many of us bank with in Maine, those are subject to similar requirements, but I will give the caveat that they are exempt from quite a few requirements because they're smaller, so the industry views them as being less risky. But from a national bank perspective, there are two main categories of regulation. So the first one is what I was alluding to before, which is consumer financial protection. And that is handled squarely by the CFPB and the Consumer Financial Protection Bureau. And that's for any institution that has greater than $10 billion in assets. But outside of that space is an entire other space called prudential or institutional regulation, and that is kind of broken out into three different regulators. And it's really talking about how the bank deals with its own money, meaning its own profits, not the money it holds on behalf of others, and also how it deals with its own risk, what type of loans it can take on and what type of loans it cannot, and what type of transactions it can engage in, and things along those lines. So there are three main regulators there. The first one is the Federal Reserve Board, commonly referred to as the Fed or FRB. The Federal Reserve Board does have some oversight of state banks that want to belong to the Federal Reserve System, but it also has oversight of bank holding companies. And bank holding companies, are a commonplace for national banks. It's actually a quasi-requirement, I would say, just given the regulatory environment and the way that regulators want certain assets to be kept distinct from others, you'll find that the vast majority of large banks have a bank holding company, so they're subject to regulation by the Fed. There's also the Office of the Comptroller of the Currency, that's commonly referred to as the OCC. The OCC supervises national banks, and really that's kind of their wheelhouse. So whenever you have a national bank, the OCC will definitely be involved in the supervision. And then the last one is the FDIC, or Federal Deposit Insurance Corporation. The FDIC predominantly deals with state banks, but there is this slight little hitch of a provision that kind of brings in national banks, and that has to do with the fact that the FDIC regulates federal deposit insurance, and federal deposit insurance is just exactly as it sounds. When you deposit money into the bank, you don't have to worry too much about it because the vast majority of us are well below the requirement of level. And so if anything were to happen to your bank and it were to dissolve tomorrow, the FDIC would step in and would make sure that you are all set and that you're going to get paid back regardless of the financial health of the bank. So if we go on to the next slide, it's just a table that's a summary of what I was just talking about. I think it goes into a little bit more detail as far as the breakout of how state banks are regulated versus not regulated. But as I said, I think our primary focus here can be on national banks because that's really the vast majority of the banks that are the big banks, and also more of my area of expertise. If we go on to the last slide of lesson 1, this is major federal bank regulations. So here the goal is just to get some name recognition, not to understand all of the tiny little aspects of the regulations. I've listed some major CFPB regulations, OCC and Fed, and then as I said, the FDIC is predominantly dealing with deposit insurance, so that is their main regulation. And you can see the regulations are pretty vast. This is just a tiny slice of all the things that we have to look at on a daily basis, but it kind of gives you an idea of the type of things that are at the forefront of financial regulation, whether it's the way we make credit decisions, or the way that we disclose your mortgage terms to you, or collect on debts. Hopefully not something that we have to do, but definitely something that banks do participate in. And then, it goes all the way down to how we deal with our own internal employees and directors and affiliates, and that's also very important, as well as how changes in control affect our organization and how we have to report that to our federal regulators so that they know exactly what's going on inside our bank and who's responsible for anything that doesn't go right. So I will pause here and give you all a minute to pause and move on to the next lecture. And there's some assigned reading on the first slide of the PowerPoint accompanying the videos. So if you want to read that and then come back and watch the second video, I will be here to walk you guys through the next section. Welcome back, everyone. So you survived lecture 1. We're on to lecture 2. And this one is actually going to focus on rulemaking activities. So hopefully you've completed the 2 major reading assignments before watching the lecture. And then I can kind of walk you through and give you some guidance on what the importance of the reading assignments were and what it means for you. So if we start first and foremost with the little graphic that I put together on the federal rulemaking process. I hope this is helpful. It took me a long time, I think, to fully grasp how the rulemaking process worked and the difference between a law that Congress passes and also the role of an agency. So if we start, the first step in rulemaking has to do with the fact that Congress has to pass some sort of statute, and that statute has to then provide some insight to the agency and kind of a direction that the agency needs to go in and what Congress is envisioning for the law that it wants the agencies to act. So if we think about the previous lecture, this really speaks directly to the Dodd-Frank Act. So Congress enacts the Dodd-Frank Act, and because they're too busy to do all of the research, they kind of delegate the actual laws that are required under the Act to the agencies, and they ask the agencies to put in the research and the time to make sure that those laws are responsive to their concerns. So the agencies kind of pick up once the Act is passed, and they publish comment requests and proposed rules in what is referred to as the Federal Register. And I'm lucky enough to read the Federal Register every morning. And people frequently laugh at that because of the fact that the Federal Register is a daily publication of all of the agency rulemaking that's issued, and it's quite dry and boring. And so I'm lucky enough to kind of go through that and have to read it and determine what in the Federal Register is relevant to my bank and what is not, and then kind of disseminate it from there. So there's the first step is, like I said, comment requests or proposals. And those always kind of include dates, and those dates give the public and the opportunity to comment. So that's kind of the way our system works. The agencies are not required to necessarily adopt your point of view, but you are entitled to give your point of view. So the public comments, banks comment, there's a lot of input given to agencies. And after the public provides their comment, the agencies review those comments, and they may or may not make changes, but they review them, and they do so before they issue any sort of final rulemaking. So once the final rulemaking is put out, the final rulemaking has an effective date, and banks know that they are expected to come into compliance with the requirements of that new law prior to the effective date. So that's kind of a gist of the way that our industry works, and the way that the broader federal government works, in the sense that this is the way that all agencies work. So it doesn't matter if it's a bank, it could be an environmental protection agency, for instance, and that would also have to follow a similar rulemaking process, because that is the requirement of the way our government and agencies interact. So if we talk a little bit about requests for information in the Paperwork Reduction Act. So as I said, agencies do have the ability to request information. Those are another type of document that can kind of go in the Federal Register that's published daily. And they can do this for numerous reasons, but agencies frequently will ask banks for financial data so they can learn more about the industry, for instance. And they can do that, but they have to be careful, because I think we all would agree that the last thing we want is to have a significant burden placed on institutions because agencies are curious and they would like to have information. So the Paperwork Reduction Act requires agencies to consider the burden of their requests and to consider if there's a less burdensome way to obtain the information from the public, which there frequently is not. And they only get an approval for an information collection from a bank for a 3-year period. So a lot of what I find is published in the Federal Register is a lot of noise, because agencies have decided on what they think are requirements for banks for information collections, but they're required every 3 years to renew that. So banks are constantly wondering if it's worthwhile to provide comment or not, when an agency, for instance, has maybe been collecting the same information for years and years upon years. And they're really only soliciting feedback because of the fact that they're required to by the Paperwork Reduction Act, and not necessarily because they want genuine feedback from the bank. So that's the gist of the Paperwork Reduction Act, and I think you'll see that you'll probably know more about that than many other people, because it took me a long time to uncover why these agencies were continuing to request comments on something that was well implemented. So it's just a little tidbit of information there, I think, that will be helpful. Then I could talk a little bit about the advocacy process. So the advocacy process is really kind of interesting. It's all back to the idea of providing comment to agencies. So once the information collection or the comment request or the proposed rule gets published in the Federal Register, there's a period of days, usually 30 is the typical time frame, that then banks and other individuals can get together and decide if they want to provide comments. So there are these giant organizations, they're called trade associations, and those trade associations kind of gather feedback from multiple banks. So where you would normally be in competition with a bank, trade associations are very interesting because they kind of bring banks together. So when you have banks of all similar asset size, they will all participate in these trade associations, and the trade association will encourage the banks to provide feedback as a collective group, because it tends to have more weight rather than having a singular bank kind of express their opinion and go out on a limb and possibly be subject to scrutiny from the regulator. So this is a little bit helpful in that sense, and is a common way for banks to advocate their points whenever there's solicitation from federal regulators. From time to time, a bank will have a unique situation, and they will not necessarily want to go with the same direction as all the other major banks. So banks are entitled to issue independent comment letters in that case and explain why something would affect them differently and how they feel about a proposed rule. And consumers can also provide comments to federal regulators. A good example of this is the CFPB recently issued a final rule on payday lending. And payday lending, for those of you that don't know, is it's highly scrutinized as predatory lending because there's very, very high interest rates, and many banks do not participate in payday lending because of that fact. It's usually what we would think of as being lenders that are in strip malls, and they advertise, cash now and things like that. Those are usually payday lenders. And what ends up happening is a lot of consumers pay tremendously high interest rates, up in the 40s or 50% for short-term loans. But these consumers feel entitled to choices, financial choices, and a lot of times they're individuals that do not have a strong financial history, so they really, really want to have access to these loans, and they want that financial freedom. So they, as consumers, put together a tremendous amount of comments to the Consumer Financial Protection Bureau on this law, hundreds of thousands of comments, and said, basically to the CFPB that they were not interested in the CFPB banning payday loans because of the high value that they held for these individuals in these situations. And that's an example of then the agency, the CFPB, had to go and review those comments, and what they ended up doing, because there were so many, is grouping them into comments that they considered to be like comments. And then after they reviewed the comments, they decided there were no alternative solutions and there's no less cost-effective way to regulate payday lending, so they did end up issuing the final rule, although they did make some exceptions to kind of give a little bit more freedom to consumers while still, in their eyes, protecting them. So that's just an example of the advocacy process and the way that it may or may not work, in influencing the regulator, but the value, nonetheless, of being able to put your opinion out there and give it directly to regulators for their consideration. So then, if we want to talk about rulemaking versus guidance, so there is a distinct difference between rulemaking versus guidance, although I think that distinction, as time goes on, has been more blurred. Agencies are required to go through a formal rulemaking process, so that's what I started out the lecture talking about, including publications in the Federal Register. But the same is not required for guidance. So if you think about guidance and what it means, guidance is really solely there to clarify. So if an agency were to issue a rule and there was an aspect of the rule that the industry was very confused on, you will find that the agency will follow up the rule with some quick guidance that says, hey, we know we weren't completely clear on a certain aspect of this rule, so we're making it easy for you, and here, this is exactly what we're looking for. Here's a piece of guidance. So I think it serves its purpose. It's highly valuable to the industry, and it's much more timely than going through a formal rulemaking process. But by its definition, guidance is not supposed to create new requirements on banks, because banks are not able to provide input before the agency issues the guidance, because there's no rulemaking process required. So banks have learned, based on expectations with regulators, that they must treat guidance as rulemaking, and because of that, I think the industry as a whole has decided that anything listed in guidance, whether or not it's official rulemaking or not, should be taken just as seriously. So it is very common for banks nowadays to implement changes to their policies and procedures based solely on guidance, even though there may not be a formal law or rulemaking requirement that forces the bank to do so. So that's just kind of a little bit of background on the difference between rulemaking and guidance, and how, in actuality, they're probably not all that different from the industry standpoint. We get down to enforcement activity. Enforcement activity is a huge part of the banking industry, and it's a major risk at all times for all banks. It's really how regulators throw their muscle around. So, an enforcement action, if you want to think of it, is kind of like a settlement. It's kind of an agreement that is made between a bank and a financial regulator whenever the regulator has found that a bank has violated a law. And it gets a little bit even more complicated with the CFPB in the picture. So, the CFPB has this kind of broad authority to monitor for unfair, deceptive acts and practices, which, if any of you have heard of the term, it's commonly referred to as UDAP. So UDAP authority is kind of broad, as you can imagine. It's not a concrete standard what's unfair and deceptive. So the CFPB has a lot of power to decide at any given moment what it thinks is unfair or deceptive, and that can change based on who's running the agency or the opinion of the enforcement team that's working with the bank. So enforcement actions have increased over the years, and I think that they are continuing to be a way to write rules similar to guidance without really issuing rulemaking. They are used to set expectations, for the industry, and if one bank does something bad, banks are at the place now where they know we better make sure we're not engaging in the same behavior because it's been publicly noted that the agency does not support that type of behavior. So it's important to take rulemaking that is violated in an enforcement action and take it just as serious as brand new rulemaking and expectations that are put out through the Federal Register. So there's been some criticism of agencies using enforcement actions as a type of rulemaking, but at the end of the day, it's important, I think, for all banks to make sure that they're reviewing enforcement actions for requirements from the regulator. There are some instances where banks get lucky and they don't have to go through a public enforcement action, and that's always the desired outcome for banks because, as you can imagine, a public enforcement action is much more negative publicity, and consumers start to question the internal workings of the bank and whether or not they can trust them. And a good example of that is Wells Fargo, which we'll actually talk more about in some of the later lectures. But Wells Fargo has recently had a slew of issues in their bank, and they were issued a public enforcement action, and it's caused a lot of negative publicity. But in addition, enforcement actions tend to also carry with them heavy punitive fines. So a lot of times, in addition to just the restitution that must be paid, the money that must be paid back to consumers because of an issue that was uncovered, there's also, these punitive fines because the bank, in the eyes of the regulator, should have known better and should have caught the bad behavior sooner. So that's another consideration. And then if we go down a little bit more into state rulemaking, just when you thought that there was enough regulation with just the federal regulators, it doesn't end there. There are also a tremendous amount of regulation coming in from states. National banks are lucky for the most part because national banks, sometimes are only subject to the federal regulation, and the federal regulation will explicitly state that it preempts the laws that are issued by the local state. So the national banks won't have to, treat customers differently based on what state they're living in, but that's not always the case. There are some state laws that explicitly say this is not preempted by federal law. You are expected, bank, to comply with my state requirements. And because of that, I think a lot of compliance departments have expanded, and they now include state law surveys where compliance is expected to keep track of everything that's going on in all of the different states. And it just has become another layer of complexity because depending on where customers are located, we have to treat them differently based on the state laws and the type of behavior that they're engaging in. So just another layer of complexity, all 50 states on top of the federal regulators that we all balance. The last one, as far as authority of rulemaking, is local rulemaking. So luckily, local rulemaking does not play as significant of a role in banking regulation. There's one main exception I can think about that I've kind of encountered in my job, and that has to do with municipal codes that have to do with towns or cities putting in certain requirements for disposal and building ordinances and electrical codes and things like that. So if we think about just real estate in general, it doesn't have to be specific to banks, but if someone wants to put in an an addition on their home, they're going to have to go and get a building permit for that. And then they're going to have to go further and have the town do an electrical inspection and a plumbing inspection. So those requirements are kind of placed on everyone regardless of whether or not it's a bank, but banks are usually not exempt from that either. So if we open administrative offices or branch in a certain location, then we will be subject to local rulemaking just like everyone else. So another layer on top of the two that we already have. So it's definitely, you know, sometimes it feels like a never-ending battle to keep track of all the regulation. So the next slide is about compliance with rulemaking activity. So compliance departments really are required to review so many sources of regulatory change and kind of stay on top of all of that, regardless of where the regulations are being issued. If they're applicable to the bank, there's an expectation that the bank will identify them and will take the appropriate action. So I think, as I said earlier, I get to read the Federal Register daily. I'm also looking at regulator websites because a lot of times they will give insight to what they're thinking about issuing by putting it on their website before actually publishing it officially in the Federal Register. And also guidance is usually published directly from the regulator on their website. So that's another source that's kind of required. But there are also a big compilation of third-party sources that kind of get to other sources of regulatory change and kind of pull everything together and serve as a good checkpoint to make sure that compliance departments are capturing everything. So that's another area that can be a valuable resource when you're responsible for all of the bank's regulatory intake. And as far as proposed rules, which I think we have talked quite a bit about, they have specified time frames, so compliance departments have to stay on top of that. They have to support their business in the advocacy process prior to those time frames, which are often tight turnarounds. And then with final rules, I think I said about the effective dates and how a lot of times there has to be very swift action to come into compliance prior to the effective date. So we will have big, robust project management teams that support compliance departments in implementing changes for the business. And, despite the fact that we may have had some preview to some of the terms of the rule in the proposed rule, it can change so much by the time it hits the final rule that a lot of times banks are scrambling to meet the requirements of the final rule, and it takes a tremendous amount of manpower and a tremendous amount of money to make sure that we're in compliance with federal rules as they're issued. So with that, I think that is the end of topic 2. So we'll be moving on to topic 3. So once again, I will give it a moment to pause, and you can read the assigned reading in topic 3, and then I will see you back for topic 3. Hello everyone, welcome back for topic 3. This is going to be an interesting one. It's trends in financial regulation. So there is some assigned reading that I hope you've completed, and I think we can jump right in and talk about the trends, and hopefully you guys will find this one pretty interesting, as I think trends are one of the most interesting aspects of financial regulation. So first, if we talk about the impact of the political environment, so I think, as I alluded to earlier, the political environment and specifically the office of the president has a significant impact on financial regulation. And President Trump is definitely in the camp of being in favor of reducing regulatory burden, and in a lot of ways, the way that he intends to do so is a lot of rhetoric around dismantling Dodd-Frank. So he has come out against many of the requirements of Dodd-Frank, and also come out in general supporting the idea that regulation on banks is just too burdensome, and because of that there's a slowdown in the economy, and that's the standpoint that he has taken. So there has been a little bit of traction, I would say, as far as rulemaking, in the sense that Congress has started drafting a new law called the Financial Choice Act. Although it's widely speculated that that law will never actually pass and never actually go into effect, but it kind of has been drafted, and I believe that it's on its second rendition, as the first rendition was not getting a lot of buy-in from any of the Democratic leaders. So the idea is, among other requirements, that the Financial Choice Act would replace the CFPB's single director, because currently The CFPB is headed by a single agency director. His name is Richard Corjoy. And one of the main aspects of the Financial Choice Act would be that that single director would be removed, and that a multi-member commission would come in and then be in charge of the way that the CFPB is run. And that's actually more common in the banking industry. It's less common for an agency to be run solely by one director. And I think, as you can imagine, the thought behind that is that agencies are very powerful, and especially with the CFPB's enforcement authority, that when you have one person's point of view kind of driving the action of the entire agency, that it's a little bit more risky for the financial industry as a whole. And I think in President Trump's case, where President Obama was the person who, put CFP Director Corjoy in his position, they may not have the same agreement on financial regulation in general and how banks should be treated. So you can imagine there's a little bit of conflict going on there, where the CFPB's director is still in power, despite not necessarily supporting the president's viewpoints. So related to the CFPB and the commission is this idea of a case that's ongoing. Actually, it's not yet fully resolved, and that's the PHH versus CFPB case. So PHH was a financial institution that had an enforcement action issued by the CFPB against it, and the company disagreed with a lot of aspects of the way the CFPB handled the enforcement action, so they decided to file suit. So that suit is currently being held with the U.S. Court of Appeals for the D.C. Circuit, and they have not issued their opinion on that yet. But one very key aspect of the litigation has to do with the fact that PHH is actually claiming that the CFPB single director structure is unconstitutional, and there is a pretty viable argument, I think. It will be interesting to see how the court comes down, because usually directors of agencies are removable at will by the president. So when the president takes over, he is not required to work with an agency director from the other political party, and someone who doesn't necessarily agree with the viewpoints of the president. But the way the CFPB was structured, the director is not removable at will, and the director actually can only be removed for cause. So in the case of the CFPB, because Director Richard Corjoy is not yet done serving his term and will not be until July 2018, right now, President Trump is not allowed to remove him unless he has some reason to fire him. So it's a little bit of a political conundrum, I think a lot of people feel, and it will be interesting to see how the court resolves the PHH case and see what they do. But there's a lot of people that disfavor the CFPB, and a lot of people were hoping that there would be more action taken against them. But I think it's widely speculated that if it is determined that the structure is unconstitutional, that the remedy will be to just implement, a bipartisan commission, and not to necessarily invalidate the actions taken by the CFPB while they were under a single director structure, because I don't think that really would be valuable for the industry, where they've already gone through so much effort to implement rules that the CFPB enacted. So from that standpoint, we'll have to all stay tuned, but it is definitely a trend in financial regulation that, I think banks are starting to question more the structure of their agencies and how they're being regulated, and whether or not agencies are playing by the rules. So I think that that's a trend that is yet to be resolved, that we'll see more about. I think we talked a little bit about enforcement actions before, but this specifically talks about CFPB enforcement actions and how banks get to the place of having public enforcement actions. And really it all relates to the fact that the CFPB maintains a public consumer complaint database, and you are all actually fully entitled to use the database if you ever feel the need. And they mine this database with various, IT programs and algorithms, and they look for patterns of behavior from banks and try to use those patterns of behavior to identify unfair and deceptive practices, and then investigate further, and then use that as the basis for their enforcement actions. So once the CFPB thinks that they maybe have identified a trend and that a bank is treating customers unfairly in a certain way, they usually go directly to the bank, and they kind of give them an investigation demand, and they say, we would like to take a closer look at something, whether it be the way we handle a product or a policy or a process, and they kind of come in and start launching the investigation. And the bank banks in general are always very eager to remedy any sort of consumer financial harm. I think that that's commonplace for the banking industry. There's no desire to harm consumers. But they're large institutions with lots of complex processes, and I think sometimes processes are not as fair as they could be to the consumer. So banks are usually pretty happy to remedy anything they can, but if the CFPB finds that their action is still more egregious than just not picking up on something that they should have, they will take that public enforcement route rather than just the private enforcement route. And I think hot topics for the CFPB as far as trends in enforcement, improper debt collection is one of them. It is never going away. The CFPB has this thought that they like to represent consumers who can't vote with their feet. And at the end of the day, what that really means is that the CFPB finds that consumers that are being subject to debt collection have no choice, and that they never wanted to be subject to debt collection, so they're not choosing to participate in that industry, and they're not choosing what debt collector is coming after them. So therefore, the CFPB views them as more vulnerable and wants to make sure that they're treated fairly. And another key area is discriminatory lending. The CFPB wants to make sure that banks are blind to ethnicities and races and all of that type of thing, and that they're lending based on creditworthiness and no other factors. Inconsistent mortgage servicing is another big one. Banks should be offering modifications to all mortgage loans, regardless of factors like race, ethnicity, ability to repay. It should just be about, offering modifications across the board to everyone who needs them and who is requesting them. So you have to be careful about what factors you consider by themselves. And then the last one is unfair credit reporting. And this is obviously a topic I think that will continue to grow in importance. If anyone has seen the recent Equifax case, which we will talk about, and consumers do not, once again, they cannot vote with their feet for credit reporting. We don't really control what information a bank gives to a credit reporting agency on our behalf. So it's kind of a vulnerable place for everyone, and we take for granted the fact that we hope banks always provide accurate credit information, but as you can imagine, there are times when mistakes are made, and banks have to make sure they're remedying any mistakes they make as far as unfair credit reporting. So with that, the next slide, as far as trends go, is the previous memo and Treasury reports. So as I alluded to earlier, President Trump has done more than just say that he supports reduced regulatory burden. Shortly after taking office in January, he did issue an executive order that directed a regulatory freeze on agencies, and he asked them to hold off temporarily on issuing new rulemaking at that time. So a lot of items were not published in the Federal Register, and they were just held by the agency, and the agencies were asked to take a second look at these regulations and postpone them, and make sure that they weren't putting too much burden on banks before they made their way into the Federal Register and were finalized. So that was a pretty immediate action. I will just say that this is commonplace. So this does happen pretty much for the most part every time a president takes over. As you can imagine, if you're stepping into a new role, you may want a little bit of time to figure out your stance on financial regulation. So a lot of presidents will issue a short-term freeze just to make sure that they're on board with everything that's being issued, and especially the case where they're replacing agency heads, because they may not trust the agency heads that are in power currently, and as new agency heads are cycled in that are going to then be tasked with issuing regulation, they want to have that grace period and that gap in time without dealing with new regulations being issued. Also, the Treasury Department was directed by the president to issue some reports and put a lot of research into their findings as far as what concretely can be done to reduce regulatory burden, not just the idea that we would like to reduce regulatory burden, but also how can it be accomplished in a way that's safe for the banking industry. So I think that's another thing that is a big trend is that the Treasury Department has issued two reports that really contain quite a few recommendations for the banking industry, and those will probably be a pretty sound guide of what's expected over the next couple of years as far as how regulatory burden will be reduced, especially in the sense that many of the recommendations issued by the Treasury Department do not require formal rulemaking. So, if the Treasury Department is able to just repeal guidance without getting, buy-in and all of that stuff, and without having to deal with the industry commenting, then it's a lot faster for them to reduce regulatory burden without going through the whole publication in the Federal Register and all of that. So on to the next slide. Another major trend is fintech, and fintech is actually the abbreviation for financial technology. So I think just about every industry is significantly impacted by improvements in technology and changes that technology make possible. So fintech firms are popping up everywhere. And fintech firms are kind of new to the banking industry. The banking industry has been around forever, and I think there's a lot of jokes that the banking industry just doesn't change a whole lot. It's really a traditional industry, and banks sometimes have a harder time being disruptors in the market and being leaders on innovation. So fintechs are not only viewed as competition by banks, but they're also viewed as great potential for collaboration and partnership and a way to stay current and competitive in the market. So if you think about the vast majority of banks have their own apps, and you no longer have to go to a bank to deposit a check, which is a new innovation of our time, and that's really prompted by partnerships with financial technology firms, and those firms are helping banks learn how to get hip with the times, I would say, and speak to what younger individuals are looking for and the conveniences that come with increased technology. There is some kind of headache with fintech firms in the sense that there's a lot of back and forth between the banking industry and fintechs, because fintechs right now, where they are new to the market, are not subject to as strict of regulation as banks are. And because of that, I think sometimes banks get frustrated because they don't want fintechs to take on too much risk and then end up harming consumers, and have it be because federal regulators weren't swift enough to act and kind of pull them into their scope and subject them to the same amount of regulation as the banks are themselves. So I think that that's a known trend that's probably going to progress over time, and as time progresses, fintechs will likely be subject to more and more regulation. And as I think alluded to, fintechs tend to innovate in more creative ways. So it's not something that necessarily regulators want to deter, because regulators also see the value of consumers being able to benefit from fintech. So there is some benefit to these firms not being as highly regulated, because they can access those consumers that maybe wouldn't have the same type of financial product offerings issued by banks. So I think as time moves on, banks will continue to partner with fintechs, and fintechs will continue to partner with regulators, and they will probably be long-lasting and here to stay in the banking industry, which will be a positive outcome, I think, for consumers ultimately. So if we move on to the next slide, as promised, we will get into a little discussion on Wells Fargo. So it's hard to read anything nowadays about Wells Fargo without there being some sort of discussion on culture and ethics. So it was about a year ago that Wells Fargo got slapped on the wrist with a public enforcement action, and it was a big enforcement action, and it had to do with the fact that there was a sales scandal going on in Wells Fargo where because of the culture and ethics there, bankers were opening accounts without authorization in customers' names because they wanted to fulfill sales quotas. So the improper sales scandal was uncovered, and shortly thereafter, their CEO stepped down, and there were further investigations that went company wide, and those investigations really spurred a lot of concern in the banking industry, as far as, do all banks have issues with their culture and conduct, and how do we know? So, Wells Fargo in and of itself has made a lot of changes to fix the issues. In addition to a CEO being removed, the business itself has been restructured, and many executives have moved on, and they've rewritten their culture and ethics framework and things like that. So, that's all good and well, but regulators started saying, well, we're not comfortable trusting every bank the way that we used to before Wells Fargo, because Wells Fargo was a very respected bank in the industry. So, what they did is the regulators decided to kind of do a review of all banks and really start asking questions about how do you know that your bank is ethical, and how do you know that your bank is doing the right thing. And through that, there hasn't seemed to be any widespread misconduct uncovered in the other banks. It seems to be isolated to Wells Fargo, as far as we know, because there have not been any more public enforcement actions issued. So that was, kind of, I think, a gratifying thing for the banking industry as a whole, because they were able to say, no, we don't have the issues that Wells Fargo had. On the whole, we are a trustworthy industry, because ultimately, all of banking is built on trust, and I think banks place a lot of value and importance on whether or not consumers can trust them. So I think regulators and banks were both relieved to know that through the review, it seemed to be an isolated bank incident, just limited to Wells Fargo. So that's the culture and ethics trend. I think that will continue on even more. I think culture and ethics is going to always be at the forefront of the banking industry, and I would not be surprised if there's more regulatory change related to mandated culture and ethics requirements, as the regulators sort through kind of their lessons learned from Wells Fargo. So there was another public enforcement action not too long ago, much more recent actually, and it was involving Equifax. And really here, it's a story of cybersecurity. So as you can imagine, cybersecurity is a huge issue for banks. They house very personal information, but in addition to banks, it's also a huge issue, probably at least as much so, for credit reporting agencies. So Equifax is a credit reporting agency that houses, our credit information, including our social security numbers, and consumers are not given the choice. These credit reporting agencies have access to our consumer information just because we've ever participated in the lending market. So in that sense, it was a big blow to credit reporting agencies when Equifax's, enforcement action went public, because 145 million consumers were likely impacted. And this is a huge trend of financial regulation, in the sense that I think all of the regulators are starting to say that there needs to be more regulation on how private sensitive information is housed, and how to prevent cybersecurity threats, and how to notify consumers, and all of those question marks that right now are not highly regulated in the United States, and there are some other countries that are a little quicker to the ball, and the US has not been as quick. So I think that's a major concern. So as cyber risk becomes more and more important for all companies, I think that banking regulators will continue to place more and more emphasis on making sure that banks are appropriately housing this information, and that will extend to credit reporting agencies as well. So if we go on to our next slide, we can talk a little bit about international regulation. So if you thought that it ended with federal, state, and local regulation, you hadn't thought about international regulation. So as you can imagine, many banks operate in more than one state. TD Bank is actually a Canadian bank, so we are subject to a lot of Canadian regulation. So, when you operate in multiple countries, you're subject to international regulation. But a lot of international regulation is kind of being discussed, at least widely, through the Basel Committee on Banking Supervision. And this committee is kind of a way for leaders from all different countries, including the US, to get together and kind of discuss commonalities between regulation in the banking industry and what should be happening to prevent systemic risk and to make sure that as a global economy that the crash of one banking industry in one country isn't going to create the crash of another. So the U.S. is a member jurisdiction of the Basel Committee, but I will say that under the new administration, there's been some discussion that the U.S. may not fully participate in the requirements that are issued by the Basel Committee, and ultimately, the Basel Committee works together to jointly recommend things that they think would be good for banking industries on an international level, but it's up to the local jurisdiction or country to actually enact the recommendation. So I think that it's likely that as collaboration increases across the banking industry and across countries, and as more and more banks go global and go into different markets that offer different benefits, that regulators will expect more global regulation and more consideration of how all the pieces fit together on the international level. So if we go down to the next slide, we are officially at topic 4. So I'll stop there and give you guys a minute to pause for the last time, because we'll move on next to topic 4, which is our last topic. So if you want to complete the assigned reading for topic 4, we will meet back for the last lecture. Thanks. Okay, welcome back everyone to our final lecture. I hope this one will be the most interesting because it's all about how financial regulation impacts you. And I get to impart a little bit of wisdom on you, I hope, related to what I've learned about financial regulation and how you can kind of take those practices and tips and implement them in your own life. So I hope that something here will add value to you and your finances and your voice as a consumer. So if we start with the first idea of how financial regulation impacts you, we can think back to the very first lecture when we talked about the Fed, or the Board of Federal Reserve. Those individuals together collectively decide the interest rates, and interest rates are a major factor when you consider finances. And as you can imagine, we live in a very fortunate time where interest rates have been low, so our mortgage payments are significantly less than our parents and grandparents, really, because we have interest rates that are around 4% versus times when interest rates were as high as 10%. So we're lucky in that sense, and who knows how long those interest rates will stay low, because the Fed has already started with the improvement in the economy, increasing interest rates, and intends to continue to increase interest rates gradually over time. So that is one thing that will probably change, but it's all based on economic growth and the level of employment, and the Fed regularly meets about 4 times a year, I would say, to really consider interest rates, and is expected, like I said, to make a few more increases. So far, they've kept it pretty small and minimal, and they've been doing increases of about 1/4 of a point of interest, which is not a tremendous amount. So we're still living in a historically low interest rate time, so that's good as far as the cost of loans and borrowing money, because it means that we're not subject to these crazy high interest rates that many people in our past were subject to. So we are fortunate in that sense of financial regulation. So if we talk a little bit about navigating financial regulations, if there ever is need for you to figure something out and you want to take on the initiative of sorting through a regulation and finding the answer for yourself, the good news is that the CFPB has your back, and the CFPB really tries its hardest to make navigating financial regulations as simple as possible. They have an entire web page, which I did include in your reading assignments, just to the extent that you may want to use it in the future. The entire web page is dedicated to providing you financial resources and helping you navigate financial regulations and how they impact you. So it doesn't matter what the product is, they've addressed several of them, whether it's credit cards or mortgages or auto loans. The CFPB really is an agency dedicated to helping consumers, and because of that, they've put a lot of time into finding ways to make things easy to digest for you. And they do require banks to provide easy to read disclosures, which also should be helpful to you, especially throughout the mortgage process. There's numerous disclosures, but also we have it a lot easier than people in the past did, in the sense that when you get your credit card bill, if you choose not to pay it off, there's a piece of paper in there that's really telling you what it's costing you to not pay it off, and sometimes it may be worth it and sometimes it may be not, but it's our own financial freedom to know, and we do know, thanks a lot in part to the CFPB and the fact that they are requiring banks and other financial institutions to take it serious when it comes to making financial regulations easy to navigate for consumers. So the other little plug I would add is that another big aspect of my job is to stay up to date on current events and news, because a lot of times significant impacts on the banking industry are not yet rulemaking, but they're anticipated. So I think that if you ever have a question about a financial regulation and you're not sure, and it seems really complicated, my best recommendation is to go ahead and look at news articles, because news articles are usually very good at simplifying the terms of a regulation and helping you understand exactly what the requirements are. So with that, I have to do my plug on student loans. So being a law student, I obviously have student loans. And, I think that as students yourselves, there's a lot of thought behind student loans. A lot of times people are very interested in what's their best option, especially when it comes to, coming time to graduate and realizing that you actually have to repay your loans, how to prioritize and what best to do in that regard. So the CFPB does regulate private student loans to the extent that anyone has any private student loans that aren't issued by the government. And so you are protected in that sense. The CFPB is there. But also, it's important, I think, to be proactive in your own finances. And it goes back to our interest rate discussion. So, you want to consider all of your debts, and you want to consider what their fixed interest rates are. And so usually that helps you understand repayment priorities. So you may have a loan that's very small and you say, I want to pay that one off first. Well, that may not make the most logical sense if that loan is the loan that you have with the lowest interest rate. And it also may not make sense to prioritize paying off your student loans if you have credit card debt that has a high interest rate, because you're just, wasting money by not paying that credit card off first. So I think it's important for everyone to take control. You should, log on to all the resources that you have. The federal government has a great site if you have federal student loans that tells you the interest rate of every loan you've ever borrowed. And then from there, you can prioritize and pay more if you can on the loans that have the higher interest rate. So that is, always worth considering. It's also important to remember that federal student loans can be deferred. So that's a huge benefit. You're not going to have any negative credit consequences that are similar to the ones that you would have with a private student loan if you refuse to pay them or you're unable to pay them. So, it's not always the best idea to pay off all your federal student loans if you have private student loans, because if something were to happen with financial hardship, you have the benefit of being able to defer those loans without having the same negative financial consequences as if it were a private loan that you weren't able to pay. And the other thing I have to plug, because it helps my life tremendously, is the benefit of certain tax credits, and especially the Opportunity Maine tax credit. So if anyone is a Maine resident prior to college and then you graduate and work in the state of Maine, there's a benchmark amount that the state will give you back dollar for dollar. So you will get a pretty hefty tax credit based on the amount of your student loan. So definitely take a look at that if you fall into that criteria, because if you use a source like TurboTax, it doesn't prompt you to use it. So you kind of have to go out on your own and make sure that you're claiming the Opportunity Maine tax credit and really benefiting from that if it applies to your situation. So those are my plugs on student loans. and how they impact you and relate to the financial world. And then I'll talk a little bit about mortgages. So for me, I never had a home until I graduated law school. So mortgages is kind of more of a new realm for me. And it was daunting. I just got my first mortgage and it was a lot of research. So I'm hoping that I can tell you a little bit about that too, and how financial regulation kind of drives what the bank is and is not allowed to do. So every aspect of mortgages are regulated by the CFPB, from origination, which is when you apply for the mortgage and it's given to you, all the way through the servicing phase, which is after the mortgage has been dispersed and you now own your home and now you're making payments back on the mortgage. So all of those aspects are regulated by the CFPB, so you are protected in that sense, and you should be receiving disclosures throughout all of those processes, especially prior to origination, as you're applying for the mortgage loan, and it should be pretty clear what the terms of your mortgage are, including, every month I get a statement that tells me how much money is going to principal and how much money is going to interest, and it's terrifying and not good, but I know at least what I've gotten myself into, and I think, knowledge is power. So that's, something that, as you can imagine, a bank doesn't necessarily like to tell the customer right up the front, because a lot of money is going to interest, but at the same time, it's important that customers know what they're paying for principal and interest, and they're not subject to any surprises. So there is regulation for that. And then the other little piece that I want to talk about is private mortgage insurance, which is also commonly referred to as PMI. So PMI is required whenever you have a loan. There are some loans that are exceptions, but generally required when you have a loan, and you don't put 20% down. And putting 20% down can be, a significant sum of money. So a lot of people cannot put 20% down. So they're required to pay PMI until their loan hits 78% of the original value of the home. So that's another consideration, because PMI is really just a type of insurance that doesn't protect you. It protects the lender in case you ever defaulted on your loan. So it is a sunk cost. So it's worth considering whether or not there are loan options available to you where you can avoid PMI, because PMI really is not about protecting you. It's about you paying to protect the lender. So there's not a whole lot of value add for you as a financial consumer there. So if we go on a little bit more, we can talk about credit scores. The CFPB does regulate credit scores. It regulates how banks report negative credit information to credit reporting agencies. I think, as I said before, if you think of Equifax is a credit reporting agency. It's not a bank. Banks do not have their own credit reporting databases. What they do is they rely on the credit reporting agencies to provide credit information to them. So if you ever, especially in the day and age of Equifax data breach, I think everyone should be proactive about looking and monitoring their credit reports. Luckily, a lot of credit cards nowadays have complimentary credit reporting apps that will kind of send you a little email every time there's something new on your credit report, and you can be notified in real time and really know what's going on and stay proactive there. But if you ever find yourself in a situation where you think something isn't accurate on your credit report, there are requirements that the agency that reported the negative information helps remedy it if it's not accurate. So if a bank reported something that's untrue, then you should contact the bank directly and see if the bank can help you work with the credit reporting agency to remedy any concerns. I think that's rare. It doesn't happen to a lot of people, but to the extent that it did happen to any of you, it's good to know that you have options. As far as your credit score, there's a lot of different factors that go in, and I think a lot of times they're not completely obvious, at least not to me. Payment history, I think, is very obvious. Whether or not you're paying your debts is an important factor. But one that is not as obvious in my mind is the percentage of credit used. So this considers, how much credit do you have overall, and how much are you using. So for me, I tend to just pay off my credit card bill at the end of the month. Well, that's not actually, the most beneficial thing for my credit score. So you learn that if you pay it off biweekly, it appears that you're using less credit even though you're using the same amount, but the percentage will never reach a higher amount because you're paying it off biweekly instead of paying it off monthly. So that's just a little tip on how you can kind of boost your credit score. And then your length of credit history, which is not something that many of us can impact because, when we opened our first credit card, we just kind of did it when we did it. Although I will say, don't cancel it, because even if you don't use it, it does impact how many years you have in the credit bureau history. So it does help you boost your score if you have one that you've had for a really long time, even if you're not using it. And then the amount of new applications, that's always a consideration. Don't fall into the trap of having people tell you, oh, it's just a light credit pull, a soft pull, and it's not a big deal. Well, the number of new applications can have a significant impact on your credit score. So you want to not necessarily take those lightly, and you want to make sure that if you are getting a loan, whether it be a car loan or a credit card, that you are using your pulls wisely, because you only have about 4 or 5 for a year before it starts having negative credit implications. So those are credit score features. Yeah, so the banks, they do use credit scores. I think it's common knowledge, but to decide how much money to lend to you. But what a lot of people don't realize is that banks also use credit scores to determine the level of interest rate. So if you have a higher credit score, you can often get a mortgage with a lower interest rate, which will save you a lot of money in the long run. So it is worth it when you can, to have your credit score be as high as you can possibly have it, while still staying within your pay range. So I think that's all important information for you guys. To talk a little bit about investments. So investments are really dependent on the safety and soundness of the financial system. So if you think about 401k plans, or people who decide to invest in the stock market, it's really about investor confidence. Investing confidence in the economy is what helps keep stock prices high, and a lot of 401k plans are partially composed of stock options. So, as the cost of compliance goes down, market confidence goes higher, because they know that the banks are going to have more money to make different business decisions and not have to put so much time and money into the cost of compliance. So I think really with investments, it's about balancing the appropriate level of safety and soundness for banks, and making sure they're regulated appropriately to avoid significant downturns like 2008, but at the same time not putting too much burden on banks, because banks do help the economy a lot and help consumers a lot by providing access to money. So I think that's the gist of investments, and how the banking industry and how it's regulated can impact your personal investments. So the last little plug I would like to make is about your voice. So your voice is really important. Banks are required to respond to you. So if you are ever not taken seriously by your bank, if something comes up and they're not hearing your point of view, you do always have the option of issuing a complaint with the Consumer Financial Protection Bureau in their consumer complaint database, and the bank will respond to that complaint. I will say that you don't have to go there first. I would highly recommend you try to resolve it with the bank first directly, because they are usually pretty receptive to resolving things, knowing that complaint database is out there. So it's always a secondary option. So consumers do have a voice in this day and age because of financial regulation, so that's really nice. I would also put in the plug that because of the high correlation between the political environment and the way that the financial industry is treated and evolving and all of that good stuff, your voice is very important in your local and national elections. So you have to figure out what your standpoint is on financial regulation, and then you have to vote for candidates who align with that viewpoint. So that's another area where your voice is important and can carry weight. So you do have a voice in that sense as well. And then I would just encourage all of you to be proactive in your finances, to set yourself up for a successful future, because I think so often people are overwhelmed by financial regulation and their own personal finances, that they do not always make the best financial choice. They make the easiest financial choice, and then later on down the road, they're kicking themselves that they didn't put a little bit more time into thinking about the terms of their mortgage, or how much interest is going to be paid on their credit card, or any financial products. So it's well within your control, and I encourage you all to use your voice. Thank you so much for participating in my lectures, and I really hope you guys enjoyed it.